welcome to another run through of the top 5 charts of the week. This is the free weekly email that goes out to subscribers of the website. I also post it here on LinkedIn so that for those who missed it or those who want to sort of, talk about some of the issues on a sort of public forum, then it's quite a good thing for that. So the purpose of this video is to go through the charts and offer a little bit of comments and context. If you can hear some squeaking in the background, don't know if you can. It's the dog. It's just put the dog around the front of the house, and she's not happy that there's no one else around there. So we'll go and throw the ball for her after this. Anyway, we'll start off with number 1, and it's US economic optimism. Recession or reset? Now, I've chosen this chart for quite a number of reasons. First of all, I was kind of inspired by a post by Tim Dewey, which I'll put in the comments of or information section of the video, where there seems to be a proliferation of bearish analysts. You could even say that some people are suffering from premature evaluation. They've already decided that this is a recession, when it's really too soon to tell, in my view. I mean, I look at this chart and what I see here is a reset. I think it pretty much is just too soon to tell, too soon to throw in the towel as well. And the fact that we haven't gone all the way below the zero line is another key point there. And as I mentioned here, the last couple of months where these are all surveys. So, we can't forget the fact that this is people who filling out these surveys, and they're liable to having influence from both, market volatility, market drawdowns, and negative news flow, which we've had a lot of recently. So, we've had the shutdown, the trade war, potential actual wars, and I think when you go from an environment of pretty much no volatility to some volatility in financial markets, it's definitely the kind of thing that can rattle sentiment perhaps more than what is justified. And another thing is, you could actually say that this little patch here was actually too far to the top side, that it was excess optimism. I think we'll find out pretty quickly, and this week actually provides another opportunity to find at least a little bit more out about what's going on. We have the flash PMIs later this week, so I'm certainly going to be paying close attention to those. Chart number 2, it is 2 alternative views of the US labour market. So we've got 2 lines here. They come from 2 things that you might have seen in the previous chart. So the Consumer Confidence Survey, and the light blue line there, and that is the proportion of respondents who said, it was easy to get a job or jobs are plentiful. And the dark blue line there is from the NFIB Small Business Survey, and that's the proportion of firms that had 1+ hard jobs to fill. So I've written there the conclusion and the headline. Small businesses, basically, it's hard to find workers, and consumers, basically, it's easy to find jobs. So this is really another way of looking at the labour market. You can actually map the unemployment rate to these 2 lines fairly closely, inverted. I haven't included it at this time, but basically, the labour market is very tight. Now, as I mentioned in the writing here, yes, these are late cycle signals, but they do provide a real-time snapshot that the labour market is very tight. And again, if this is just a temporary reset, then charts like this are going to become all the more relevant. And the reason is because, if you re-accelerate in the condition of tight, tight capacity like this, then we might see that fabled thing called inflation. Number 3 is China loan growth. So the black bars there, that's new loans in and that's in billions there on the left hand side, and that's in Chinese yuan or renminbi. And on the right hand side it's M2 money supply growth year on year. And really the point of this, showing this one, is just that the money is still flowing. M2 growth rate has been on a structural slowdown, so there is that, but it looked a slight tick up there. Not really much more to say on this one because I want to talk a bit more about it in the next couple of charts. But basically, you generally always tend to see a spike in new loans in January, so it's not unusual that you'd see this. It is a big number, it is a new record high, and certainly my view is that we do see more stimulus out of China this year. But let's have a look at chart number 4, kind of a punchline. So this kind of puts it in context really. These bars are monthly growth in TSF, which is total social finance, which is a more all-encompassing, broader view of credit growth. Basically it's bank loans plus other, all sorts of either non-bank, shadow bank, etc. And it's normalized against nominal GDP. And the purpose of this, or the immediate thing that stands out there, is that it's, well, one, it's not a record high for one. It still hasn't, in a normalized sense, surpassed what we saw in 2009, which was absolutely gargantuan stimulus, and we probably won't see stimulus like that, I'd say at least for a few years, until we see like a real big crisis. I mean, we're definitely seeing a slowdown, and at this point we'll jump back and forward a bit. At this point we'll jump to the last chart. So we're definitely seeing a slowdown here. We can see in the red line, that's the Composite PMI, that's the mix of the manufacturing and non-manufacturing PMIs from China. Bit of smoothing applied to that as well, and you can see that we're back to those levels that we saw in 2015-16, where for all intents and purposes there was a recession in China then. Not a recession in the usual sense, because they don't really run their economic data the same way that other countries do, and things are on a kind of different scale there. But for all intents and purposes, if you track the macro pulse there, China was basically in a mini recession at that point. What's not shown on this chart, which is a really important piece of information, is property prices were actually declining then as well on a year-on-year basis. They had one of their worst property declines in recent history then. So that is another really important moving part, because at the moment property prices are rising, and that kind of puts a constraint in the immediate term in terms of what they can do for stimulus. I mean, I fully expect them to really step up their stimulus game, especially if there wasn't any kind of trade agreement. I think they'll definitely come up with some sort of agreement, and on that front it's really just a matter of time, because there's some really big issues that both sides are grappling with. They've got the opportunity, both sides have got the opportunity to actually do something pretty big, pretty good, and then there's always the possibility that they in the end say, well, let's just agree to not disagree and come up with something symbolic. That would be, in my view, kind of like the worst case scenario, because, well, it would be a good case for markets because it would just kind of sweep the issue under the rug, but it would come back again at some point. Anyway, point is, we've got a softening in the macro pulse in China, and generally when we see things weaken to this extent, you tend to see some stimulus package, and yes, the January, it is normal to see a spike in new credit growth in January, but it is it's certainly up there. But really what you want to see to get excited about this is some follow through in the February numbers. So really it's a bit of wait and see to see if we get, you know, even more, you know, very material growth in credit in February on a normalized basis, and indeed, you know, whether we see some wider monetary policy measures such as a move in the benchmark, which would, you know, that would send a very strong signal, or more triple R cuts, which we'll probably almost certainly see. And you know, there's other things that they can do for fiscal and tax cut front as well. So, you know, that continues to be my base case. We probably do need to see a little bit more economic pain there before they really step things up, but you know, I think this is probably, you know, it's probably fair to say that this is the first sign of some decent stimulus coming out of there. And as I mentioned, I think here, or up here, yes, depending on the size and scope of the potential stimulus package out of China, this could be an important upside catalyst for global risk assets. And that's the bottom line for the China charts, really. And we've got the copper price, that's a pretty important one to note. If we do see a stimulus package in China, that's probably where it's going to show up in the copper price. China remains one of the most important consumers of copper amongst other commodities, and that's why, you know, if you see you know, some resolute signs of stimulus in China, then it's going to be game on for commodities in emerging markets. So keep an eye on China this year. Now, if you want to get these 5 charts of the week in your email box, there is a link there which you can click. I'll put that in the comments and description of the video, and you can sign up and receive these direct to your inbox.